The price is lying right now, and the spread is telling the truth. And that's why the next 2 weeks matter more than the last 2 months. Because the story you're being sold is simple. Metals are up, everyone's scared, end of story. But the market's actual message is sharper than that. It's mechanical, it's scheduled, and it has a habit of humiliating people who confuse a headline with a signal. Stay with me, because later I'm going to give you the exact 2-scenario roadmap for the next 1 to 2 weeks. What confirms the move, what breaks it, and the one level where the math changes. Gold didn't just drift higher lately, it changed character. The tape has been acting less like a polite uptrend and more like a regime shift. Bigger candles, faster responses to macro prints, and that distinct feeling that dips don't last as long as they used to. Silver, meanwhile, has been doing what silver always does when it senses a new monetary narrative. It stops being a chart and starts being a stress test. And that contrast matters, because if you're building crash protection, you don't want vibes. You want structure. You want to know which parts of the move are real demand, which parts are forced hedging, which parts are thin liquidity, and which parts are just the market baiting you into emotional decisions. Here's the uncomfortable truth most people don't say out loud. When metals move like this, the market's first reaction isn't celebration. It's risk control. And risk control looks like selling, not because the world suddenly got bullish on banks, not because the thesis is over, but because big players are paid to survive volatility, not to predict headlines. When price accelerates, risk managers reduce exposure. Volatility targeting funds cut positions. Dealers adjust hedges. Futures players roll or rebalance. And all of that can push against the move even while the underlying reasons for owning metals are getting stronger. And that's where the real pressure starts. So if you've ever felt like gold and silver rise, you finally feel right. And then the market immediately tries to rip the confidence out of your chest. Good. That's not you being cursed. That's the structure doing what it does. The next detail is what flips the whole setup. The largest seller you from now I'll run into in the near term may not be a human opinion at all. It may be a calendar. There's a predictable rules-based seller that shows up on a timetable. Not because they want to crush you, because their mandate forces them to. Commodity indices rebalance. Portfolios that track them adjust weights. Funds that mirror them have to sell or buy specific contracts in specific windows. It's scheduled. It's boring. And it's powerful enough to distort price discovery precisely when everyone is watching the fireworks and calling it mania. That's the hidden detail. The market doesn't just move on fear, it also moves on deadlines. And if you don't know what week you're in, you'll misread the tape. Now, let's get something straight before we go any further. This is not a get-rich-on-silver pep talk. This is a crash protection playbook, meaning you're building something that survives chaos. A protective allocation is not measured by how clever it looks on a chart. It's measured by how it behaves when the system is stressed, when liquidity disappears, when correlations go to 1, when the trades you thought were diversified suddenly all bleed together. Metals can help in that environment, but only if you approach them like a strategist, not like a tourist. And that's the point of this video. You're going to leave with a plan that tells you what to do when the market tries to scare you out of the right idea at the wrong time. Because here's the trap. Gold and silver are not one market. They are a negotiation between paper leverage and physical availability. And that negotiation shows up first in places most people never look. Not the headline price, not the meme chart, the plumbing, the spreads, the term structure, the way nearby contracts behave versus later contracts, the way dealers hedge options, the way inventory becomes available in theory but not deliverable in practice. But that's not the part that gets clipped into a 10-second clip on social media, so it's ignored. And if you ignore it, you end up reacting to noise while the real signal is flashing in the background. Let's break down the mechanics simply. In the paper market, futures, options, derivatives, you can control a lot of metal exposure with relatively little cash. That leverage is why price can move fast. It's also why price can get slapped down fast. In the physical world, bars, coins, industrial supply, things move slower. There are lead times, refining constraints, logistics. Sometimes there's metal somewhere, but not in the right form, not in the right location, not on the right schedule. And when those two worlds disagree, you see it in the structure. You see it in spreads and premiums. You see it when the front end gets tight. You see it when the market is basically saying, if you want metal now, pay up. And that's where the story becomes evidence-driven instead of emotional. Here's proof point number 1, term structure. If you've never cared about backwardation or contango, you're not alone. But in metals, that curve is a lie detector. In plain language, contango is when future prices are higher than spot, often reflecting storage, insurance, and financing costs. Backwardation is when the near-term price is higher than later prices, often reflecting urgency to get metal now or tightness in nearby supply. Now, do not take this as a simplistic rule that backwardation equals shortage. Markets are messy. But when the front end tightens aggressively, it tells you something important. Someone is willing to pay extra to solve a near-term problem, and that forces participants to do things they don't want to do. That's what matters this week. Because when the front end is tight, shorts carrying positions face higher pressure. Rolling becomes painful. Dealers hedging exposures need to adjust. Arbitrageurs step in to capture dislocations, and the market becomes reflexive. Price movements change behaviors, behaviors change flows, flows change price. That reflexivity is the engine behind many of the sudden metal moves people swear came out of nowhere. But they didn't. The spread whispered first, and the next detail is what really matters. Spreads don't care about narratives. They care about settlement. Proof point number 2, inventory is not a single number. The internet loves to say there's plenty of gold or silver is everywhere. It's a great way to sound confident while knowing nothing. In practice, what matters is deliverability. Some inventory is eligible but not registered. Some is held but not for sale. Some is in the wrong form. Some is already spoken for by industrial users. And that's why you can see situations where aggregate vault holdings look fine, while the market's behavior screams stress. If you're building crash protection, you don't need to memorize categories. You need the intuition. Not all metal is available metal, and not all available metal is deliverable metal, and that mismatch is where price can gap. Because if this one level breaks, the math changes. Proof point number 3, positioning and open interest. When a metal moves, you need to know whether it's being driven by fresh participation or by forced exits. A rally with expanding open interest often suggests new positions entering, more fuel, more conviction, more potential for a squeeze if it turns. A rally with collapsing open interest can be short covering, powerful, but sometimes more fragile once the forced buying is done. Same with sell-offs. A drop with surging open interest can be aggressive shorting. A drop with falling open interest can be liquidation, forced selling that may exhaust itself. You don't need to be a futures pro to benefit from this. You just need to stop treating every red candle as thesis broken and every green candle as guaranteed. The market is constantly revealing whether it's being pushed or pulled. Proof point number 4, institutional flows and the way safe havens substitute for each other. In a normal world, people talk about stocks versus bonds. In a stressed world, people talk about cash, dollars, and what they actually trust. Gold shines when trust migrates, not just when fear rises, and trust can migrate for reasons that have nothing to do with the day's headline. Currency stress, policy uncertainty, real rates wobbling, geopolitical risk, balance sheet games. When those forces intensify, gold stops trading like a commodity and starts trading like insurance. But insurance is always fought over because if too many people decide they want it at once, the price of insurance rises and the sellers appear. And that's where people get shaken out. Proof point number 5, the on-the-ground symptom, premiums, availability, and procurement behavior. You don't have to live in a vault to sense stress. When retail premiums widen, when delivery times stretch, when industrial users talk like buyers instead of gamblers, you're seeing the physical market vote. Sometimes that vote is subtle, sometimes it's loud. But it's never perfectly synchronized with the paper price because the paper market moves on leverage and hedging, while the physical market moves on logistics and necessity. And when those two markets fall out of rhythm, the arbitrage mechanism becomes the bridge. That bridge is where the hidden detail expresses itself in price discovery. Let's talk about arbitrage in simple terms because this is one of those concepts that sounds academic but is brutally practical. If metal is cheaper in one region or one form and more expensive in another, traders and institutions try to profit from that difference. They buy where it's cheap, sell where it's expensive, and in doing so, they pull prices toward each other, like a magnet. But arbitrage isn't magic. It's constrained by shipping, refining, financing, and timing. If those constraints tighten, the magnet gets stronger and bursts, not smoothly, which means the price can jump, or gap, or whipsaw. And this is exactly why crash protection with metals cannot be a single emotional entry. It must be a ladder with rules. Now we need to deal with silver specifically, because silver is where people get hurt the fastest, and where they can also get the most upside if they respect the rules. Silver is not just a monetary metal, it's also a supply chain input. That dual identity is why it behaves like a polite asset one week and a wild animal the next. Silver supply is heavily linked to byproduct production, meaning a lot of it comes out of mines that are primarily mining something else. That creates constraints. If the primary metal's economics change, silver supply doesn't respond cleanly. Recycling helps, but it has lead times and price sensitivity, and industrial demand doesn't politely wait for your chart pattern. It shows up when procurement cycles hit, when inventories are rebuilt, when there's a scramble to secure inputs. So silver can experience bursts of demand that collide with supply and flexibility, and the paper market amplifies that collision with leverage. And that's not the part that matters to casual observers, but it matters to you. Because if you're using metals as crash protection, You need to understand the difference between a trend signal and noise. Trend signal is structural. Spreads, persistence, repeated defensive key levels, macro backdrop aligning, real demand behaviors. Noise is the market trying to shake weak hands, a violent pullback on thin liquidity, a scary headline that reverses the next day, a sudden dollar spike that fades a futures washout that looks like the end, but is actually a reset. And this is where the psychology shield comes in, because volatility is a weapon the market uses against you. Not because anyone is out to get you, but because the market's job is to find the price where the maximum number of participants make the maximum number of mistakes. Here's how the emotional manipulation usually works. First, metals run, and everyone who ignored them feels late. Then the headlines switch from gold climbs to gold bubble. Then a pullback hits, often during a time window where liquidity is thin or flows are forced, and it feels personal. People who just bought get immediately punished. Then the commentary gets cruel. See, it was all hype. Then the market stabilizes, then it moves again without them. That cycle repeats because it's effective. And your job is not to be fearless. Your job is to be rule-driven. So let's build the playbook. And I'm going to keep this grounded. No guaranteed returns, no magical targets that pretend the market is a vending machine. We're going to talk in terms of levels, scenarios, and what the market is forced to do. First, define your purpose. Crash protection is not the same as a momentum trade. A momentum trade can be tight, aggressive, and fast. Crash protection is layered, patient, and designed to survive whipsaws. That means you don't all in at one price. You build a core, and then you add tactically when the market proves itself. The core is what you hold through noise. The tactical layer is what you manage around structure. And if you don't separate those two, volatility will trick you into selling the core at the bottom because your tactical entry got torched. That's where people blow it. Second, accept that metals can drop hard even when the thesis is correct. This is the credibility test. A protective asset can whip around violently because leverage exists in the paper market. A short squeeze can reverse, a gamma-driven move can unwind, a forced rebalancing can hit. None of that means the world is suddenly safe. It means positioning is being reset, and resets are often the setup for the next leg. But you only benefit if you have the emotional protection to stay rational. Now, the why now trigger. Here's what makes the near-term window important. Calendar pressures, month-end behavior, fund rebalancing, options expiries, delivery windows. And those scheduled events matter more when liquidity is thin, like when markets are risk-off, dealers are cautious, and everyone is watching the same levels. If you've ever seen a market move that felt too violent for the news, there's a decent chance you are watching calendar meets liquidity, and that's the pressure point we're exploiting in a disciplined way. Let's talk options reflexivity for a moment, because this is one of the most underappreciated engines in fast metal moves. When a lot of call options are bought, dealers who sell those options hedge by buying the underlying exposure. As price rises, the hedge needs to be increased, buying more. That can create a feedback loop. Price up, hedging buy, price up more. That's the gamma effect. On the flip side, when price falls, hedges are reduced. Selling can accelerate. This is why you can get vertical moves that feel disconnected from fundamentals, and then equally sharp pullbacks that feel like betrayal. It's not betrayal, it's a mechanical unwind. And if you understand it, you stop taking it personally. Because the next detail is what flips your behavior. You start using volatility as information instead of as an insult. So here's the 2-scenario lens for the next 1 to 2 weeks. You don't need 10 predictions. You need 2 clean scenarios and a checklist. Scenario 1 is the controlled pullback and retest. In this scenario, metals cool off because forced selling or rebalancing pressure shows up. The tape gets choppy. Headlines declare victory for the "it was just fear" crowd. Price pulls back toward a prior breakout zone. Think in terms of the last major consolidation area or the last clean swing level that launched the move. The key is not the size of the pullback. The key is the behavior at the level. Does it stabilize? Do dips get bought faster than before? Do spreads stay relatively firm? Does silver stop bleeding and start basing? If yes, that's the market proving the move is structural, not emotional. That's your add environment if you're building protection. Not when it's euphoric, when it's testing and holding. But that's not the part that matters to most people. They buy euphoria and sell tests. You do the opposite. Scenario 2 is the continuation squeeze with gap risk. In this scenario, the market shrugs off the calendar seller faster than expected. Liquidity thins, and instead of fading, price continues to stair-step higher. Silver starts leading again because silver often leads in the hot phase. You see sharp intraday reversals upward. You see failed breakdowns. You see the market refusing to give discounts. That's when you must respect gap risk. Because in a squeeze, pullbacks can be shallow, and then the next move can be a jump when liquidity is gone. In that environment, you don't chase with your entire plan. You let the core do its job, and you manage the tactical layer carefully. Because if this one level breaks, if the market finally does give you a deeper retest, you want dry powder. The market rewards those who are prepared, not those who are desperate. Now, let's translate that into practical rules without turning this into a spreadsheet lecture. Rule 1, separate core from tactical. Decide what portion of your metals exposure is do not touch unless thesis breaks, and what portion is I will manage around levels. That alone prevents most panic selling. Rule 2, define your invalidation before the market defines it for you. Invalidation is not the price went down. Invalidation is the market behaved in a way that contradicts the structural thesis. For example, repeated failures to reclaim a major breakout zone, spreads collapsing in a way that signals the tightness story is gone, or a shift in macro conditions that removes the need for insurance, like a genuine credible policy pivot that restores trust and stabilizes currencies. Those are thesis threats. A scary day is not. Rule 3, ladder entries don't marry a single price. If you want crash protection, you build exposure in pieces, especially in silver. Silver will humiliate anyone who tries to be perfect. You can be right and still get shaken out if you go too heavy at one level. A ladder turns volatility from a threat into a tool. Rule 4, watch the right dashboard. Here's your near-term checklist for the next 1 to 2 weeks. 1, how does price behave around the last major breakout area? 2, do daily closes hold above key supports after pullbacks, or do they keep slipping? 3, do you see sharp failed breakdowns that reverse quickly? That often signals strong hands absorbing supply. 4, do you see spread staying firm even when headline price dips? That's the price is lying, spread telling truth signal. 5, do you see silver stabilizing relative to gold after sell-offs, or does it keep underperforming? Relative performance matters because it tells you where risk appetite inside the metals complex is heading. And here's the twist most people miss. The market will try to use volatility against you by weaponizing your time horizon. If you're building protection, your horizon is not the next hour. But the market will shove the next hour into your face. It will make you feel like you must act now. It will make you feel foolish for not selling, or foolish for not buying more. And that's why you need one more psychological rule. You only make size decisions at predefined times, like end of day or after a weekly close, unless your invalidation trigger hits. That single rule prevents you from getting yanked around by intraday theatrics designed to trigger emotions. Now, let's talk about the other side, because this is where the skepticism crowd needs clarity. When metals rise, it's tempting to say, they're suppressing it. But you don't need a cartoon villain to explain what you're seeing. Incentives and structure are enough. Dealers hedge, banks manage inventory and risk, funds rebalance, shorts cover when margins bite, longs reduce when volatility spikes. These are all rational behaviors within the system. But rational behaviors can still produce outcomes that feel manipulative to a retail observer, because retail doesn't see the constraints. Retail sees only the candle. The candle is the final print of 1,000 forced decisions. And once you understand that, you stop asking, who did this to me? And you start asking, what did the structure force them to do? That's the only question that pays. So what is the structure likely forcing participants to do right now? It's forcing them to respect volatility. It's forcing rebalancers to execute regardless of price. It's forcing hedgers to buy into strength and sell into weakness, sometimes accelerating moves. It's forcing anyone short in the wrong spot to cover into illiquidity. And it's forcing the casual crowd to learn, again, that silver is not a calm asset. And that's why a crash protection plan is not a prediction. It's a set of reactions. Let's get specific about what to watch next, because this is where people either become professionals or remain emotional. Watch for the retest behavior. A healthy structure often looks like this. Price runs, pulls back, finds support near the breakout zone, chops, and then resumes. A dangerous structure looks like this. Price runs, pulls back, and each bounce is weaker, each recovery is slower, and spreads loosen noticeably. The first is consolidation. The second is distribution. And you can tell the difference not by guessing, but by observing. If the market snaps back quickly after dips, that's demand. If it struggles to recover, that's supply dominating. Now, for silver watchers, add one more layer, reflexive overshoot. Silver can overshoot to the upside because of leverage and narrative heat, and then overshoot to the downside because the same leverage gets unwound. The protection mindset doesn't interpret that as silver is broken. It interprets it as silver requires sizing discipline. If your silver position is sized so that a brutal drawdown forces you to capitulate, you sized it wrong for protection. That's not moral judgment, that's math. And this is the quiet warning. Volatility will be used against you, and if you don't pre-plan, you'll become the liquidity for someone else's strategy. Now, let's pull back and connect this to the bigger crash protection logic. Crash protection is about owning assets that behave differently when confidence breaks. Gold has historically played that role across regimes not because it is perfect, but because it is outside the credit system in a way most assets are not. Silver is messier. It can trade like a risk asset in some windows and like money in others. That's why silver is not a substitute for gold in a protection plan. It's an enhancer, a volatility lever, and in some scenarios an outperformer, but it requires rules. So a sensible playbook often looks like gold as the stability anchor, silver as the tactical convexity. The percentages depend on your tolerance, not your ego. So here's how you turn this into an actual plan you can execute without panic. Choose your core exposure. For many people, that core is primarily gold because it tends to be less psychotic. Then decide if you want a smaller silver sleeve for upside and for the scenario where industrial and monetary narratives align. Then decide your add zones, areas where if price pulls back and holds, you add tactically. And decide your trim zones, areas where if price goes vertical and structure looks overheated, you reduce tactical risk without touching the core. That's how professionals stay in the trade while amateurs get shaken out. They move the tactical layer, not the conviction layer. Now I'm going to say something that might annoy both extremes. If you're a pure skeptic who thinks metals are barbarous relics, you're missing the role they play in a world of credibility stress. And if you're a pure zealot who thinks metals only go up and every dip is manipulation, you're also missing reality. The truth is in the mechanisms. Metals are assets that respond to macro trust, liquidity, and structure, and those factors are not stable. That's why you need scenarios. Let's close with the next week and next 2-week roadmap, as promised. Base case, we get a pullback or chop during calendar-driven flows and risk control. You watch the last major breakout zone. You watch whether daily closes hold the key area instead of bleeding. You watch spreads for signs that the plumbing remains tight. You watch silver's relative behavior. Does it stabilize and start catching bids on dips, or does it keep acting heavy? If the base case plays out, your tactical adds happen into stability, not into panic. Confirmations look like failed breakdowns, faster dip buying, and an inability of bearish headlines to keep price down. Squeeze case, metals keep pushing, dips stay shallow, and price moves in bursts as liquidity thins. In that case, your core rides. Your tactical layer is managed with respect for gap risk. You do not emotionally chase. You let the market come to your rules. Confirmations look like quick reversals higher after small dips, resilience into supposed bad news, and signs that participants are being forced to buy. Short covering, hedging demand, or rebalancing pressure, meeting limited liquidity. Invalidation, because you always need it, looks like a decisive failure back below the major breakout structure that doesn't reclaim quickly, accompanied by loosening in the structure signals that were supporting the move. It's not a one-day scare, it's a behavior shift. If you can't define invalidation, you don't have a plan, you have a hope. And hope is expensive in markets. Finally, here's the subtle CTA, and it's not begging. If you're the kind of investor who wants receipts, mechanisms, and a checklist, if you'd rather be early with a plan than late with a headline, then you're already in the right room. Stick with people who think in structure, not in slogans. Because the market doesn't reward the loudest narrative, it rewards the best prepared risk management. And in the next couple of weeks, as the calendar pressure collides with liquidity and positioning, the people who survive will be the ones who can look at a violent candle and say, calmly, is this trend signal or is this noise? And when you can answer that, you stop being tradable